Thank you. Good morning. Firstly, I think on behalf of all of the panel, I'd like to say how glad we were to have a coffee break. I didn't particularly fancy following Denny's performance. We haven't got the graphics or the jokes, I'm sure, but we'll see if we can improvise. So firstly, just to introduce my fellow panellists, on my immediate right, I've got Euan MacLaren, who's the MD and head of the UK and Ireland institutional business for Natixis. In the middle, I've got Linda Kerrigan, who very kindly has stepped in at short notice. It's a change from what's in the published schedule. So Linda has stepped into the breach at fairly short notice. And Linda is the chief actuary at Irish Life. And on the far end, I've got Sean MacHale, who's executive director and head of institutional banking for Danske Bank. So we've got an interesting mix of views or viewpoints on the industry. Myself from a credit rating perspective, an insurance company, a banker and an asset manager. And the low yield environment is a topic that has cropped up regularly at a number of conferences I've attended and has been going for some time now. So, but there are early indications, and I think our previous speaker, a former economist, pointed out that there are some indications that perhaps the low-yield world may be coming to an end, but maybe not that soon, but maybe we are seeing the change of that cycle. And we see the Fed in the US talking about raising rates again in June, and we're already seeing signs within the Eurozone, within Europe, the ECB recognising that inflation is now running at close to 2%, and there's even talk of tapering of the quantitative easing programmes. So whilst I think there may be light at the end of the tunnel, but it's been a long tunnel and I think there's still some way to go. So I've got one slide that I just put up to start the discussion, which is what we've seen from a credit rating perspective in terms of the impact on the industry of a low interest environment. And if I could have my slide up, please. And this slide really just looks at what we've seen in terms of the reaction of the insurance industry to that low interest rate environment and low yield world. And on the left-hand side, I've got a list of impacts on products and what's happened to the change of the shift in product mix and product design. And we'll come back to that in a moment. But I'd like to start more on the right-hand side in terms of how companies themselves and the industry has responded to that low yield world. And specifically, what I'm talking about is how we've seen companies respond to a low-yield environment and try to search for increased yield. So perhaps I can start with you, Euan, and just ask in terms of how you see the industry's response.
Thank you, Greg. Yeah, it's been interesting. It's been 10 years probably now we've been in this cycle. There's been a period where balance sheets can stand the low returns, even the negative returns. But as we move through that age-wise and time-wise, it becomes more and more difficult to really support the business on the balance sheet side from there. And what we have seen is this move from the plain vanilla fixed income and equity, a small amount of equities in the portfolios, to really that search for yield. Now that search for yield then brings in a number of questions. Yield, quite often in this environment, will bring increased risk. It brings new asset classes onto the table, onto the discussion table with the regulators. How do you best access that yield? And what we have seen is certainly a growth in real assets. So insurers looking at both property, long lease, CPI, RPI linked income channels for running over 15 to 20 years. Infrastructure, again, very strong income flows. But how do you treat the asset? And then you've got the newer lines coming in, such as aircraft financing, which is a new area. It's an area which is generating a lot of interest. Again, to get that yield coming through. Now, the key point I have is we've gone from a very vanilla style of investment in the insurance businesses from 10 years ago to looking at these new asset classes. And you're right, you mentioned that rates will rise, and we're starting to look like we're entering into that rising rate environment. My argument would be that simply because we're going into a rising rate environment does not mean that we should just go back to the vanilla style of investment. What we should be doing is trying to build portfolios of assets which allow us to cushion our balance sheets against the future drop in interest rates again. Because it will. Everything is cyclical. We will see cyclicality in this market. Thereby, if we have our plain fixed income, our higher yielding fixed income, and then perhaps some equity or some real assets in there, we then should create portfolios that next time we come to a very low rate environment, will give us that cushion at the bottom. It means we're not going to 0.5 or minus 0.5 yields coming through from the assets.
So when you talk about some of those new asset classes that have emerged, many of those asset classes, though, come with issues of liquidity.
Yes.
And if you move to a higher yielding environment generally, then there's a trade-off. And will investors be happy with, will there still be a sufficient margin to cover that liquidity risk?
Yes, there will be. I mean, the thing is that we need to look at the liquidity demands of the business. We need to look at the illiquidity premium that you may get from returns from that asset class. And from that point of view, everything has a cost, but what we need to do is start putting risk first as well and looking at the risk to the overall business, to the portfolio of assets, and saying, okay, this is an acceptable illiquidity premium, a risk that we're taking for this income stream going out and the security of the asset underneath that. And then you get to the question of, well, some would say the capital charge and the SCR on some of these asset classes is not beneficial at the moment. And I think both the asset management industry, the insurance industry, and the regulators need to get together to look at how we can build more stable, and stability came up earlier, stable portfolios for the future, which are not going to be penal in terms of the capital charges that are applied to them.
Right. So, Linda, perhaps you could make a few comments from an insurance company's perspective, both in terms of how you've responded to the environment, but also what your thoughts are for a rising yield environment that perhaps is not too far away.
Sure. I suppose first, there's been a lot of talk about the impact of low interest rates on the insurance industry, but I do think it's not a homogenous group. So really the impact very much depends on the product mix of the insurer and the underlying sort of asset liability management strategy. So if you take the Irish market, for example, product mix really in terms of savings, investments and pension products would tend to be on the unit-linked side. So really it is the policyholder and the customer taking the underlying investment risk. And then on the non-linked side, on the annuities and on protection, you would tend to see insurers really well matching the assets and the liability cash flows. So in terms of the impact on the in-force portfolio or the immediate balance sheet impact, I would say for the Irish market, the UK market is somewhat similar in terms of product mix, has been quite muted. But of course there are wider impacts for our customers, and we can come on to that a little bit later. In terms of more just shareholder impacts, it is obviously with falling returns in sort of your free assets, it is harder to earn the historic levels of investment returns that you would have sort of earned in the past, although even that point really depends on how capital intensive your product mix is, and therefore how important is the return on your free assets to your overall return on investment. Just to some of the points that you were just making there, I think I suspect companies are starting to look at sort of in pockets as a part of a diversified strategy. Is there value in going into alternative or new asset classes? I think you had mentioned some good points there about really understanding the risks of new asset classes. How does that fit with your overall risk appetite? How do you manage the liquidity risk? Obviously, Solvency II, which Euan touched on, is an issue. I also think there's an issue about capabilities and in-house expertise. So if you're going to go into these new asset classes, as I said, you really do need to understand the risks and what are your capabilities to appraise new opportunities and even to compare between the different types of asset classes. And that is a challenge for insurers to build up those capabilities. And indeed, if it's going to be part of a diversified strategy, do have critical mass to actually make it warrant building up those capabilities. So then on to rise in interest rates. Yes. So yeah, I guess it's a world where we always have to be prepared for every eventuality, a prolonged low interest rate, and then possibly a rise, whether it's a sharp rise or a gradual rise in interest rates. So I suppose given the asset liability matching strategies, I think a sharp rise in the in-force portfolio will be relatively limited. So it's really back to our customers and that a sharp rise in interest rates or even a gradual rise, what does that mean? And we heard in the last presentation what that might mean in terms of overall valuations of what it could mean for the value of growth assets, which have been doing very well over recent years. So I think that's back to really preparing the customer for the potential volatility that they could see within their asset classes. Now, many of our customers are investing for the very long term. So the impact of volatility in terms of their long-term savings goals or retirement goals would be relatively limited over a short period. They're saving regularly over a very long period. But we do have investors that are investing more for the short to medium term. And so there it's really back to the conversations you're having during the advice process up front about the level of volatility in the underlying asset classes. But that is a challenge.
Yeah. So, Sean, can I perhaps ask you to make a few comments just in terms of how the banking industry's coped? So I took a quick look at Danske Bank's results, and profits have been rising steadily for the last 5 years, so the low yield environment seems to have suited you very well. But in terms of how you interact with the insurance space, sure. Perhaps you can make a few comments.
Yeah, sure. I think, we've certainly had a good run of it in that, but that's because I suppose we've addressed the low yield or the negative yield environment very, very early on. We look to grow fee income in a much more meaningful way as part of our top and bottom line. In terms of how it's affecting the insurance industry, unfortunately our view would be that low rates are here for a little bit longer. We don't see any movement in the ECB until 2019 because quite simply we think that they have to taper off QE, and the way we see QE at the minute is that that'll be extended in September, albeit at a lower amount to about 40 billion or so. And I guess to put it in context, it's, to use the phrase, the perfect storm. What we've seen is obviously under the Solvency II model, that's created some mispricing in assets, misallocation of capital, coupled with the ECB on the QE program. So during April, I think they hold something like 1.8 trillion of assets. 1.5 trillion or so is in European governments, sovereigns, agencies. But if you look at the covered bond space, it's about 220 billion or so in covered bonds, which is 30% of the entire market. And all this quite simply means that it's forced yields lower, and to a point where it's difficult for insurers, particularly on the asset management side, to pick up assets under the Solvency II framework where they would like. And back to Euan's point, that's led to a big search for diversification within the low rate environment, obviously with the forward-looking bias towards rate hikes in the future. However, that's in the context of QE and then QT, which is quantitative tapering, which the US are now only looking at. So again, it's some way off. So one asset class that we like is corporate loans from a banking perspective, and that in the double B, single B category. Why we like it? I suppose looking at it just as a standalone asset class, first of all, the yield, it's returning about 4.5%, presently 6.5% in the US. It has had positive returns for the last 19 years or so on an annualized basis, 60% of the time greater than 4%. From a risk perspective, when we look at the default risk, historically it runs at about 3%. In the current credit cycle, it's running at about 2%. However, there's about an 80% recovery rate with that. And then when we put it into a Solvency II setting, what we find is that it's getting a capital treatment of 20 to 25%. Loans are floating rate, so when rates rise, it'll pick up that by default, and the vast majority of these loans are floored at zero, so you're not taking the negative charge into it. So it's just an example of, I suppose, an asset class that we like at this point in time, given where the rate environment is at, coupled obviously with real assets. I mean, everyone likes infrastructure. Some of the issues with infrastructure is not alone the illiquidity, but the availability of infrastructural projects. And that, so again, is to have lots of different solutions in one's armoury in terms of that wider diversification play.
Okay, well, let's sort of shift more towards the consumer perspective and the impact that we've seen on products across the industry. So, we've seen people providing lower and lower yields, increasingly shifting towards unit-linked products, so taking the capital-intensive elements away from the company's balance sheet and giving that to the policyholder. Linda, can you just comment about where you see that trend continuing, and would that extend into a period of rising investment rates?
Well, in the Irish market, we really have been sort of, the move to unit linked is sort of it's done, it's long established, like it's really been a 20 to 30 years sort of journey for the Irish market. So I don't see in a rising interest rate, we've had rising interest rates and we were a unit linked market, so I don't see that going back. I think, I suppose though, I still think there is the insurer has a huge part to play in whether it's a prolonged low interest rate environment or a rising interest rate environment in helping the customer in their expectations of what they're going to get from the product. So notwithstanding unit linked, I think there still is a very big role for the insurer there. So I guess if we are facing, and there's different possible outcomes and theories, but if you are facing a prolonged low interest rate environment and potentially lower returns in the investment markets, then how are we calibrating our customers' expectations to those lower returns? Like how do customers calibrate their expectations to essentially a new normal? I think insurers do have a part to play in that in terms of both the communication to their clients, the product design, and the design of their advice processes. So take, for example, a few examples of the Irish market would be just the sort of reduction in projected growth rates that the industry would have adopted over the last 5 years in light of a low interest rate environment, but also the sort of importance of the risk profiling of the customer and aligning that to risk rating of underlying funds. And even over the last few years, you've seen more companies, including Irish Life, doing more in the range of return space, trying to communicate to the customer just both the expected potential returns, but also the variation in those underlying returns. So even in a unit-linked market, I think there's it's a different type of challenge, but it's not a balance sheet so much challenge, but there is still a big role for the insurer to play.
So I've been studying the insurance sector for many years, more years than I care to admit to, and I've worked for a number of rating agencies during that time. And what I've seen generally over the course of the last 30 years has been that shift, as you've seen, the shift to unit linked within the Irish market, which we've seen in other markets as well. And generally that move to shift the risk off of the balance sheet of the insurer and more onto the policyholder. And that's fine if that's what the policyholder wants. So my question is, if you go back 20, 30 years, then the traditional life insurers would occasionally depend upon banks and asset managers to be business partners and to help provide those solutions. But as you increasingly, whether it's through product design, regulation, consumer interest, whatever it may be, as you increasingly move to an environment where the policyholder is taking the risk and dictating the asset allocation, doesn't that open up the market to the competition from pure asset managers and banks to short-circuit the life insurance companies and to provide those longer-term savings solutions, perhaps no longer wrapped under a life insurance policy, but to take more of that savings market directly? So how does that traditional relationship change over time? Anybody want to?
Do you want to go first and I'll go second, or do you want me to go first?
You go first.
All right, I'll do it then. I mean, it's really, crucially, the first thing is whether it's an asset manager or an insurance company dealing with the public, it is this question of putting risk first now. We're away from the times of guaranteed bonds, etc. What is it the individual is trying to achieve? How can we, as an asset manager or an insurance company, help them achieve that? So it is this risk-first approach. What is the level of risk you're willing to take? What is your expectation? What is it you want at the end of this investment? And let's work to get you to that by structuring a portfolio or a product which will get you to your end goal. It's not about what the person, your neighbour next door, is doing, on your left or on your right. It's about what do you want to achieve with your money at the end of this. And that is where the industry is changing. And the industry is having to become more engaged with its end users to a degree. And yes, it does open up scope for us. I mean, we run systems which allow us to work with advisors and model portfolios, etc., which looks at risk first and then structuring a portfolio to achieve the end goal of that advisor and their clients at the end. There's no difference, and it shouldn't matter who does it, and it is competitive, but the end issue has to be to provide the result that the individual needs, because we are, much as we may think we're different industries, we're not. We're, in the eyes of the public, we are viewed as a whole. We are viewed as the financial services industry.
Yep.
So that would be my point there. We need to engage better, we need to put risk first, and we need to help the individual realize it's not about what someone else does, it's about what they want at the end of their term of investment.
Sure.
Yeah, I would just, I suppose, add just probably, I think it is already competitive. Like if you take the Irish market is a competitive space. We have been living with that, competition with sort of investment managers and other sort of vehicles for quite some time. But it's probably not an either or as well. So like you do see insurance companies through platform products, wrapper products, offering access to other asset managers as well. So I don't think it's not a black and white. I think it inevitably does increase competition, and we've already seen that in the Irish market, but it's not a black and white either or, I think.
Yeah, I sort of agree. I think that's a very accurate reflection that the competition has already been there, and again, you can see that through the platforms. And to Euan's point, it should always be about the end user, and that's the most important thing, and that should see people choosing different investment strategies, different wrappers, and that in order to achieve the type of investments that they want. And I guess it's our job then to be able to support and create those in turn from them, from that kind of feedback through those kind of platforms.
Okay, we got a question from the audience, so perhaps I will go to that, which is, thank you, Praveen. So a question for the panel. Given the low yields on investments are here to stay for a while, are the insurers likely to increase premium rates to maintain or even increase profitability for their shareholders? I don't know if anyone wants to take a stab at that. Perhaps the insurer in the room.
Well, I think to my earlier comments, not on the unit-linked side, obviously it's quite a different product range. You have seen on the annuity products, obviously, given the matching strategy comments I was making earlier, those products are matched at outset from an interest rate risk perspective. So you have seen falling interest rate leading to increase in annuity rates over the last 10 years. And that has impacted demand in the individual annuity market. But to be honest, even in the individual annuity market, the sort of approved retirement vehicles, which would be the alternative vehicle of choice for post-retirement, as as a more sort of giving the policyholder more flexibility than an annuity, and that already got a strong foothold in the Irish market. So yes, there's obviously a direct correlation where if you're going to use asset liability matching, which is generally the case in the Irish market for annuities, there will be a direct impact. But there are already other forces at play in terms of the popularity of approved retirement funds, so it's more been a continuation of a trend rather than a new impact. And overall, I don't see companies sort of going beyond that in terms of pricing.
So one of the other issues that from an observer's perspective, I've seen across the industry has been in that low yield environment. And although Denny Kessler talked about all those fantastic growth opportunities that seem to exist, we haven't seen premium volumes going through the roof for any particular class of insurance apart from one or two specialist areas. What we have seen is a tremendous focus on costs and expenses across the industry, and that's been a driving trend now for many years. And I'd just be interested to get the panel's view as to how much further that can go. Are there benefits to be gained from technology? Are there benefits from economies of scale? Where's the next big win in terms of driving costs out of the system? And obviously, perhaps from a bank's perspective, Sean, you can comment.
Yeah, I mean, obviously technology will bring cost savings in the longer term. However, quite clearly, I think you're going to see consolidation within the sector in that, both from a regulatory and a cost perspective. In simple terms, some of the smaller players will just need to be subsumed into larger ones in that, because you can't control really the regulatory cost. banks can control it, insurers can control it, and it has gone up exponentially over the last number of years. And obviously with Solvency II, MiFID II coming into place, even asset managers are now facing that challenge. So I think absolutely technology will help, but technology is a large capex expenditure at the outset. However, I think really what you'll see is consolidation in the sector, and that's where efficiencies will be found, and costs will be able to be reduced over the medium term.
Anybody?
I mean, from my point of view, we have faced downward fee pressure for a long time in the asset management industry, starting first maybe with pension funds, coming on to insurance. It is something that we can deal with, something we need to adapt to. And through use of technology, the use of perhaps altering the products that we produce to a degree, we can manage this. And again, in some ways, that downward fee pressure, if it goes through to the end user, the end investor again, is a good thing, because we want people to feel that there is value for money. There is a lot of interest now in value for money when it comes to the DC pension fund market and the large insurers who are running DC default funds, and whether there is true value for money underlying those funds are being offered to the pension contributors. So I think, yes, costs will become but it's not going to go away. I think the days of a lot of cream on top of the industry is gone, and as well it should be, because we're there to provide a service to the insurance industry and to the person in the street, and that's where a lot of the transparency work that we're doing within the investment industry is really starting to help to try and get a clear sign of what the costs are, the costs associated, and the underlying or supposedly hidden costs, although I do not accept there are hidden costs within the business.
Okay. As a rating agency, we love to think about doom and gloom scenarios. What could be the worst case? We spend some wild afternoons speculating on these types of issues. One of the, not necessarily a worst case scenario, perhaps a potentially likely scenario, is that we continue in a low yield environment, but we see rising inflation. And I think that it's probably been one of the benefits, perhaps more so for the non-life sector than the life sector in recent years, that low inflation has meant low claims inflation. And because of the time lag of claims emerging, particularly on liability business, that's really helped to boost results in recent years, or to prove that reserves were very comfortable in recent years. So rising inflation almost has a sort of hidden effect more on the non-life side, in terms of that tail emerges sometime down the line, and you may not have been able to price it significantly. But more from the life perspective, what would you see as the potential impacts of a rising inflationary environment whilst we continue in a low yield environment?
I think it's really, I suppose, it depends on your product mix and the sort of level of inflation linking you have within your liabilities. But I would say the main impact is going to be on your expense base, which gets somewhat back to that last question you were asking, Greg.
Yeah.
So it's really coming back to the cost base.
And from a bank and asset manager's perspective?
Well, from our point of view, inflation is something which there's a great concern about, and what we have been doing is looking at, again, with these real assets that I talked about in the first point, is how can we take these assets and create a inflation-proofed stream of income running out 15, 20 years from now. And we've managed to take some equity investment and create a debt-style product, so a senior note and a junior note, where the guaranteed lease income over a 15 to 20-year basis, which is CPI or RPI linked, can go into the senior note, which the insurer bank can then apply for on the matching adjustment, and then the actual asset itself and the unconfirmed income going forward is in the junior note. So it's all about being able to work with the industry to develop this type of product, which A, solves a problem for the insurer, and B, gives us a product we can take to market that meets that risk of being able to eliminate some of the inflation-proof side.
Okay. And Sean, we're running out of time, but perhaps a final comment from you.
Yeah, I think as Euan was saying, through the product side, real assets certainly give you an inflation impact in that. And again, what we see is more demand from the insurance community towards issuers. particularly sovereign issuers, to issue inflation linkers and that to give them a better liability match and that. So again, we don't see that going away anytime soon. We think actually, if anything, there's a lot more pent-up demand for that type of issuance, particularly in the longer end of the curve and that. And again, you know, if we look here locally, Ireland did a century bond last year. France are regular issues in the 50-year, and we'd like to see more of that because not alone does it give long-dated assets, it also gives you a lot of convexity, which obviously is very important from an insurance perspective.
Okay, sadly we've run out of time. I'd like to just apologise. We had a couple of questions come in very late on, so unfortunately we haven't got time to address those in the panel right now. But thank you very much for your time, and perhaps we could thank my panellists for their input.